Warning signs. Is Canada's housing market about to crash? And are Canada's banks contributing to the potential economic disaster? US and UK experience similar real estate turmoil. This week many news articles suggest that the housing market in Canada, the US and the UK seem to be following the same trajectory. And the general direction is down. Canada's banking regulator steps in to rein in the bank's excessive and risky loaning practices. Canada's banking regulator has imposed higher capital requirements on the country's largest banks for the second time in about 6 months. According to BNN Bloomberg on June 20, 2023, this is a signal of concern about risks building up in the financial system. Mortgage debts are having to be restructured so that home borrowers do not default in large numbers. Credit card debts are increasing quickly. And corporate debt is also high. According to Yahoo Finance, the regulator's move is a signal of concern about economic and financial risks that lie ahead. Together with anticipated higher interest rates from the Bank of Canada later this year, the regulator's move will lead to a tighter credit environment which will drastically reverse the increases seen recently in the housing market. Both sales and prices could plummet. Surging real estate prices in Canada will not last, says Royal Bank of Canada. Canadian real estate prices are surging, driven by the pause in the Bank of Canada's interest rate hike. However, the momentum is expected to be short-lived as rising interest rates and increasing supply will likely balance the market. Despite improvements in inventory, excess demand remains. RBC, the largest bank in Canada, predicts that the current strength in the market will not last due to the rate hike and further tightening of monetary policy. This could reverse the recent surge in home prices. Canadian missed debt payments surge and credit debt grows. Canadian credit debt rises as cost of living and missed payments surge. According to Equifax and a Toronto Star article in early June 2023, non-mortgage bills saw a 19% increase in missed payments in Q1 2023. High interest rates and rising expenses contribute to the financial strain. The Bank of Canada expressed concerns over debt management. Credit card debt continues to climb, with consumers spending 21.5% more monthly. The situation poses risks and suggests a troubling trend for Canadians. The article discussed the fact that individuals facing financial difficulties will first pay their mortgage. However, when difficulties persist, they'll then start missing their mortgage payments. Temporary surge in Canadian real estate prices and sales may just be the classic dead cat bounce. Canadian real estate market experiences temporary boost in prices and sales, but economists warn of a continuing correction. According to a Better Dwelling article on June 19, 2023, existing home sales rose 5.1% in May. Despite the increase, sales remain below the 10-year average. Economists predict a 10% drop in home prices by early next year due to rising interest rates. Prices are still 12% below the record high in February 2022. The market resurgence is seen as a brief pause before prices resume falling, with an overall decline of 20 to 25% expected from the peak in February 2022. A dead cat bounce is a financial term used to describe a temporary and brief recovery or upward movement in the price or value of a declining asset or market. The term is derived from the notion that even a dead cat, when dropped from a significant height, will experience a bounce. Canadian mortgages about to get more expensive. BMO expects 2 more rate hikes by Bank of Canada. BMO expects the Bank of Canada to implement at least 2 more rate hikes after their surprise June 7, 2023 increase. According to a Better Dwelling article, the Canadian economy is running strong, with elevated core inflation, record employment, and rising GDP. The last rate hike has led to an increase in 2-year and 5-year yields, indicating that mortgage rates may soon follow suit. This development could slow down the momentum in the housing market, which the BOC is unlikely to be concerned about. The article suggests that the BOC's actions reflect a deliberate attempt to curb housing demand. Powell's Bombshell. U.S. Federal Reserve Chair says more rate hikes needed to combat high inflation. The U.S. Federal Reserve Chair Jerome Powell stated that due to persistently high inflation in the United States, further interest rate hikes are likely to occur this year. According to an article by the Associated Press on June 21, 2023, Powell emphasized the need to bring inflation back down to the target rate of 2%. The recent decision by the Fed to keep interest rates unchanged after a series of 10 consecutive hikes has led to increased uncertainty regarding the central bank's next moves. The article also highlights the divergent views among politicians regarding the Fed's policies. Some want continued rate hikes to combat inflation and others supporting the decision to pause. Powell also mentioned that the Fed's decision to keep rates steady was influenced by the recent bank failures and their potential impact on the economy. The central bank's future actions remain uncertain and will be determined based on evolving economic data. Popularity of variable rate mortgages plummets to pre-pandemic levels, and Canadian banking regulator tells banks to address risks of amortization extensions. Statistics Canada says the popularity of variable rate mortgages has significantly declined and is currently approaching pre-pandemic levels, according to an article by Canadian Mortgage Trends on June 20, 2023. Only 8% of new mortgage originations in April opted for variable rates, compared to 92% for fixed-rate mortgages. This decline follows a peak of nearly 57% in January 2022 when variable rate mortgages could be obtained at a historic low of 0.99%. The average variable rates now range between 5.5% and 6% due to multiple rate hikes by the Bank of Canada. In terms of fixed-rate mortgages, new borrowers are increasingly favoring shorter terms. While 1- and 2-year terms comprised 42% of new originations at the beginning of the year, they have now been surpassed by 3- and 4-year terms. In April, mortgages with terms under 3 years accounted for 39% of new mortgages, while those with terms of 3 or 4 years made up nearly 41%. Notably, 5-year fixed mortgages, which were traditionally preferred in Canada, now represent only 12% of originations. Additionally, the Office of the Superintendent of Financial Institutions, OSFI, in Canada has urged lenders to address the risks associated with extending amortization periods. Due to rate hikes by the Bank of Canada, variable rate mortgage holders with fixed payments have experienced longer amortization periods, potentially leading to higher payments when the mortgage contracts renew. OSFI emphasizes the need for proactive account management and the recognition of higher risk in loss provisioning. Meanwhile, the Teranet National Bank Composite Home Price Index, after 10 consecutive monthly declines, showed a 0.6% increase in May compared to April, seasonally adjusted. However, the index remains down 8.1% year-over-year. Among the 11 housing markets in the composite index, 8 experienced increases, with Toronto, Winnipeg, Victoria, and Edmonton leading the gains. Calgary, Edmonton, and Quebec City saw annual gains, while Hamilton, Toronto, and Ottawa-Gatineau witnessed declines. The report suggests that the recent rebound in property prices is mainly attributed to the recovery in the resale market and record demographic growth, contributing to the shortage of housing supply. Nevertheless, the Bank of Canada's tightening monetary policy and an anticipated economic slowdown are expected to moderate house price growth later in the year. U.S. home prices fall by largest amount annually since December 2011. The National Association of Realtors reports that U.S. home prices fell in May at the largest annual rate in over a decade, according to a CNN article on June 22, 2023. The median existing home price was $396,100, marking a 3.1% decrease compared to the previous year, the largest year-over-year price reduction since December 2011. Sales of existing homes rose 0.2% from April to May, but were down 20.4% compared to the previous year. Mortgage rates have been volatile, ranging from 6.09% to 6.79% this year. Regional variations in prices show declines in the West and South, while the Northeast and Midwest saw price increases. Lack of inventory has led to nearly one-third of homes selling for above list price. Total housing inventory is down 6.1% from a year ago, with unsold inventory sitting at a 3-month supply. Home building has surged, but affordability remains a challenge due to low inventory. Bank of England hikes interest rates to 5%, stoking fears of a mortgage bomb and housing price declines. The Bank of England raised interest rates to 5% due to persistent inflation, leading to concerns over a mortgage crisis. According to a CNN article on June 22, 2023, the move will impact mortgage holders and house prices. The decision came as inflation remained high at 8.7% in May. The forecast suggests rates may reach 6%, affecting over 2 million mortgage holders. The rise in rates will dampen consumer spending and potentially deepen the UK's economic slowdown. Prime Minister Rishi Sunak faces a challenge in meeting his pledge to reduce inflation. House prices are expected to decline by 5%, with mortgage holders facing higher monthly payments. The situation may lead to a prolonged mortgage crunch. Longer-term loans and accumulated savings could mitigate the impact, but a decline of up to 25% in house prices may occur if rates stay high. How severe the sales declines and price drops will be is largely dependent on how many more rate hikes are required by the central banks to get inflation in each country under control. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.